Tushar Bohra joins in from MK Ventures to talk about exactly that. Tushar, hi, good morning. Good to have you in the studios. What should we say? Deja vu of past 3 years?
Well, well, I was hoping markets would be green when I showed up, but such are the days. One interesting thing before we start off, right? I was going back to one of my poems from 2019, and well, the macros, a lot of the things still seem the same. Trump was talking Greenland and Red Sea back in 2019. Cut to 2025, we have more of the same. So I think a lot of emphasis is being placed on global macros, and a lot of tough things. People are talking INR, people are talking gold. Frankly, most of us wouldn't even understand how these things will shape up, because some of these are multi-year, if not multi-decade trends. The better thing to focus is to focus on specific stocks, specific pockets, bottom up, rather than be worried about the markets overall.
So at MK Ventures, are you fully invested? Are you sitting on cash?
We are not fully invested. We had created some room for cash. We had a view that things would be slightly more difficult this year, and thankfully we've been in cash across portfolios, and we have started deploying.
So why have you not deployed completely? I mean, why have you started deploying? You're just thinking some more downside is there, or this is like a tactical smart call? Dheere lete hain.
So I think it's difficult to predict the bottom. In fact, if you look at this, maybe it's good to put this in perspective right now. Unlike COVID, where you had a very sharp fall in a very small period, led by a very clear and specific trigger. This time, this is more like a boiling frog syndrome. The temperatures continue to go up, the markets are continuing to drag. You don't know where this will end, and this is not the time to try and predict the bottom of the market. It's trying to construct portfolios, looking at one pocket at a time. Wherever you see correction is sufficient, earnings resilience is there. Wherever you see that you are getting good attractive opportunities, you start deploying. You don't want to be fully deployed, because you don't want to be in a situation you like something, go all out and buy, and then it's down 10% from your buying price. So we are gradually going to be deploying cash through this year, but I would like to say that the pain this time is real. There are a lot of people out there who have put in all of their savings into the markets and in a lot of risky pockets. There's a lot of working capital from SMEs, MSMEs that has actually found its way out of the business cycle and into the markets, and which is now seeing a lot of correction. So this is not the time to be trying to be brave. This is the time to be having your head about you. There are enough good opportunities out there, and more will emerge through this year. Do your work. Focus on pockets where there is a clear earnings momentum, or at least valuations are now more palatable, and start buying, continue to buy. We are not looking to go all out aggressive, but we are looking to take the opportunities as they come.
So where do you find valuation comfort right now, Tushar? Because it really seems like a consensus on the street that banks is the go-to space.
And for good reason.
Yeah.
Banks have underperformed for quite some time. The large private banks, not much that's happened over the last few years, even though earnings have been much better in some of them. On the smaller side, in fact, if you look at banks and NBFCs overall, across the board, you will see most of them are trading below their 5-year average price to book multiples. And most of the, some of the good private banks, smaller banks are trading at below 1-time book. A lot of the NBFCs are trading below 1-time book. Most of the PSU banks are trading below 1-time book. So there is definitely a lot of valuation comfort in banks. Again, it's a large sector. It's not a small weight. It's almost a 40% weight in the Nifty, in the index overall. So if the next round of leadership has to emerge, financials is very well placed to take that leadership. Because there's valuation, the cycle seems to be turning around. Regulatory constraints start to be going away now. I think some of the recent initiatives by RBI are clearly steps in that direction. So it seems that things are now starting to come together, and this is definitely not the time to be negative on financials. It's also not the time to go out and buy everything that's in sight. That is where I think this year will provide us the opportunity to differentiate with our work. Rather than going and buying everything, you identify, take your picks, you'll get the valuations that you thought are attractive, probably in some cases even better valuations than that. You do your work, be ready, you'll get the opportunities to buy. And financial certainly is one pocket that I think will do well over the next couple of years.
But other than banks, Kunal, which other pocket is looking attractive to you, or rather the kind of strategy that you are adopting to deploy selectively? Which are the other things that you're looking at?
So we are looking at, let's say consumption is one basket. Last 3 years, consumption, the performance has been mixed. A lot of the stocks were very richly valued, and the earnings, performance was mixed. And you are rightly seeing a lot of correction in the consumption basket. Increasingly, there are good pockets emerging in that space. As a house, we've been bullish on spirits, right? There's a lot, let's say QSR is one theme, apparels, some of the retail names, the smaller companies. So there are pockets where value could start to emerge now. And you should be focused within the broader consumption basket. You should be focused at identifying specific places where there is a resilience in earnings, where you think that the next few quarters earnings will, be, even if there's a slight possibility of positive surprise, these stocks will outperform the broader indexes significantly.
Okay, so let's start dividing the market into the concerns. Why are markets down? Earnings are down and valuations are expensive, and top of that there is this global uncertainty. These are the only 3 factors which are leading to the market reset, and then there is technical selling. 4 factors hai, ek ko address karte hain. Technical factors, how much more selling is left, how much more small and mid cap stocks, margin call will happen. What is the way to judge that?
So, like I said, rather than looking at the entire universe, see, most of us are looking at 20-25 stocks in our portfolio, right? Unless we are large institutions, and a lot of the audience out there is actually retail, HNI, people who are looking at specific stocks. I think you should, rather than trying to look at all the pockets, find things that you understand well. There are a lot of small cap and mid cap stocks that are available now at single digit multiples. Having said that, because the technicals matter when the fundamentals are sound. You look at technicals to give you a direction of the market. When the fundamentals you can take a view on. But a lot of the supply that has come in the last 3 years, a lot of these smaller companies, so-called extraordinary businesses, very good quality businesses with J-curve earnings projections. What you'll find is in the next 12-15 months, a lot of that cover will wear off. Stocks which supposedly were extraordinary quality will turn out to be average quality businesses. That J-curve earnings will
Where will that happen? Will it happen in, let's say, fintech, as in the internet space? Could that happen in defense? Could that happen in SMEs? Because there are a lot of spaces where everyone thought that India will grow and these companies will grow. India will grow at 12% and these stocks will grow at 15% and earnings will grow at 20%.
So in fact, if you look at, let's take a couple of the hot themes of the last 3 years, right? EMS as a pocket, railways as a pocket, defense as a pocket, right? Renewables as a pocket. Now, we're not saying that all of these are bad companies or where there's not enough earnings support. But if you have a stock which is trading at 150 times PE or 80-100 times EV EBITDA, and you are expecting a 35-40% earnings growth, CAGR for say the next 3 years, even if it delivers 25%, that's still a big miss. And at 150 PE, probably you don't have room for that kind of a negative surprise. So it's not that the earnings will not come through in these pockets, but just that we have factored in so much growth ahead that these stocks will not be able to deliver in a lot of cases. And then there are pockets where simply the companies have a lot of fraudulent companies, smaller companies, which are only narratives, only hype and hope stocks. There you will start to see that what you were assuming will be let's say 26, 27 earnings, you'll probably never get that even 29, 30. So you have to identify and see if the market falls, let's say if the broader index falls from here, even a good quality stock, some of them will fall. Even something which appears attractive at say 20 times EV EBITDA is definitely there's a possibility it can come down to 15. So rather than trying to, I don't know, to be frank, I'm not a technicals guy. I do know one thing, that there is still a large pocket of froth out there. Not everything is corrected. And at the same time, last 2 years, SME pocket, the earnings have been good. Balance sheets are much better. In fact, on the 5 leverage concepts that I track closely, if I may take a minute to just quickly highlight, if you see, most of these companies are not really leveraged. The promoters are not really leveraged. So that I don't think is a bit of a concern. Some of the portfolios were leveraged, which I think is the last 1 month or 2 months of correction has taken care of most of that. But what's still out there is two different kinds of leverage. Leveraging on time, you're looking at earnings beyond 2027, 28, 29, 30. I mean, I've seen stocks where earnings of 2035 are being projected. Right? Which is absurd. Yeah, which is absurd. And I'm sure that that's not the...
You want to name them?
I would refrain from naming them. But I would say that there's enough stuff out there for you to track. So that's one thing, where you don't have a near-term earnings comfort. And the last category, which is the most risky category, is you're leveraging on the narrative itself. Only hope and hype rather than substance. And a lot of these companies that claim to be extraordinary businesses, you'll find that when like you say, when the tides are rising, everything seems to be sailing. But you'll find a lot of these companies will leave investors high and dry. So this last two pockets of leveraging on time and leveraging on narrative is the pocket that I want to avoid.
Sure.
In this run.
Tushar, the one space that you guys track very actively is pharma sector, right? Some of the earnings have been pretty much at par with expectations or even performed better actually. But again, that whole tariff uncertainty, you don't know which way US's positioning is going to be. What's your thought on pharma? And if there are any, spaces within pharma, because each company has a very, unique model, you can't really club them up together. Anything that you think is investable right now?
So, within pharma, I think API CDMO basket is one that we are very bullish on. Have been bullish for last few months, maybe slightly more than a year, and we continue to remain positive on this space. A lot of the mid-cap companies in this space, we could probably see earnings double in the next 2 to 3 years, which I think, given the market situation overall, is a good space to be in. Regards the tariff noise and the macro narratives, just take couple of contrasting data points. So Trump is talking tariffs.
No.
We are also talking Biosecure Act. We are also talking tariffs on China, which means that a lot of the manufacturing does get shifted out of China to India. I'm sure China plus one is a narrative you hear every day. And then we have Eli Lilly talking about manufacturing APIs in US. Now, anyone who's tracked US markets or global manufacturing space will know that there's no way that Eli Lilly can be competitive on price manufacturing APIs based out of US. More importantly, see, once we move beyond a skill set, it's very rare that you are going to be able to come back. Let's say if I was very good at Excel modeling 10 years back, 5 years back, today I'm no longer doing that. For me to assume suddenly that out of the dust I'll pick up my Excel files and be able to be good at it again, I mean, that's a joke. So let's be practical. There are a lot of contrasting narratives. In fact, for the record, it's interesting that the most influential politician out there right now is talking oil and gas, and his closest friend is one of the titans in electric vehicles.
EVs, yeah.
So obviously there's a lot behind the scenes that we don't know about, and rather than focusing on the narratives, we should focus on our work. We should focus on bottom-up constructs. Keep things simple. Keep your thoughts about you. There's enough and more opportunities. And pharma definitely is one area where I think there'll be very, very strong earnings growth in the next 2 years.
But the other space also, Tushar, before we wind up, tourism, right? You go to an airport and you know what's the stage. Or for that matter, even check airfares on your computer. How is it that you can best capitalize on this theme?
So interestingly, we are supply constrained in tourism.
Yeah.
I think there's room for more hotels. There's room for more airlines. I mean, quote unquote, a lot of us would be happily willing to consider alternatives to Indigo in a lot of sectors if they were available. So,
but you've invested in SpiceJet. You want an alternate for Indigo. Your firm is investing in SpiceJet. ये क्या हो रहा है मतलब?
I would not want to.
No, I'm just putting facts out. ये तो public information है.
Yeah,
As a customer, I want Indigo. But I'm investing in SpiceJet. Am I missing on something?
No, I'm saying, in fact, if there are
No,
options
he
available
said
to Indigo.
if there were options, he would move beyond Interglobe as a
you move
consumer.
beyond Indigo.
Yeah.
Okay.
So I'm saying that there is room for more flights, more flying capacity. I mean, if you've been to Mahakumbh, you know that a lot of us would have had to shell out a bomb just to even go there.
I didn't go only. I didn't shell out a bomb. I didn't go only. Much better.
Fantastic. Likewise, actually. But So, see, my thing, let's say, again, not wanting to name a specific stock, but let's say within tourism, there are one or two niches where there are only, maybe one player or two players listed in that niche. And some of these are large companies with multi-year track records and available at very reasonable multiples.
Sorry, this is outside of aviation.
Yeah, outside of aviation, within tourism as a basket overall. Now, from a bottom up, and trying to align some bit of macro to it, where is the pocket where government has a lot of focus on, and which can immediately, see a quick recovery, and which can also have a multiplier effect on the GDP, which is not that, from a regulatory standpoint or from a macro standpoint, which is insulated a little bit to some of the negatives out there. Tourism is a very, very good basket. There are a lot of companies in that sector, and if you do your work well, that is one sector you probably can get very good investment opportunities for the next 2 years. Likewise, as I said, there are few baskets, few opportunities in the product consumption space that you should look at. I won't comment specifically on SpiceJet, but yes, we are bullish on aviation as well.
No,
as
but
sector.
since the consumption did get a boost from the budget as well, so apart from tourism, any other pocket where you believe that the money will flow in, maybe it autos, maybe it consumer discretionary, any of those places where the valuation comfort is still there?
So I was doing this exercise over the weekend itself. You just look at, you take the entire consumption, autos, auto anchors, and autos, in fact, the balance sheets are much better right now. So probably more defensive in that way. But there are a few good auto ancillary companies available at less than 10 times EV/EBITDA at very reasonable PE multiples. So that is one pocket that maybe you can look at. Within the broader consumer discretionary space, again, the idea is that not everything is cheap and not everything will move up. So it's not saying, and I'm not saying that let's say you go out and buy every FMCG company out there or every consumer durable company out there. What I'm saying is that this is the time to start looking at these segments, and in each segment there will be one or two companies where earnings were a bit of a challenge in the recent past. Valuations have now corrected to very attractive levels, or where earnings are consistent. You wouldn't have bought them 6 months earlier, but now the valuations have corrected, giving you a buying opportunity. And see, the entire direct tax cut, I think the power of that as a sentiment indicator is probably not appreciated enough. And it will be, over the next few months and over the next 2-3 years, we'll begin to realize that this could be a very, very key trigger to change the sentiment overall. Once you have consumption starts to pick up, you'll again see more demand. That will lead to another round of private capex, hopefully, and the economic momentum that the government is seeking. This could be an important trigger to achieve that. So, in my view, you look at each segment, do your work, identify one or two good companies that have corrected sufficiently, and where you think near-term earnings, there is a positive surprise possible. That is the important word. If you're assuming 10% and you get 12-13%, that is also a positive surprise. And a lot of these stocks are not primed up to see that.
Yeah, this shake-off has brought down our expectations also, I guess. But good chatting with you, Tushar. Thank you so much for taking the time out and joining in today.
If you like this video, then like, share and subscribe to ET Now.